Good morning from the Asia Pacific. We are half an hour away from the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles here in Hong Kong.
And I'm Avril Hong in Singapore. Our top stories: Asian stocks under pressure as fresh U.S. data points to sticky inflation despite slumping economic activity, adding to uncertainty over the Fed's next move on rates. Traders also on watch for updates on trade talks between the U.S. and China as President Trump says a deal with Beijing is within reach. And we're looking ahead to the Reserve Bank of India's rate decision as Trump's warning of higher tariffs clouds the inflation outlook. And we've got some breaking news for you. We were watching Cathay because earnings are coming up. This is, of course, a stock that's risen 50% in the past 12 months. But this Bloomberg scoop is a big one because it is showing how Cathay could be poised to make its first Boeing order in 12 years. And, of course, David will continue to unpack the significance of this potential order for the Hong Kong carrier, not just for the airline, but also what this means for Boeing as well. As we know, some of these jet orders have become increasingly politicized under Donald Trump. But first, a look at the market action for the day.
Yeah, absolutely. And as you point out, right, so we could get confirmation from the company when the company reports results today, and certainly that is one key theme to track today. I mean, a lot of stocks that we're tracking, Yum China, of course, reported. So that's the earnings theme, which I think we can get into in more detail in a moment here. Broadly speaking, though, and speaking about the earnings theme, I mean, decently heavy docket when you look at the likes of Japan and South Korea, for example. But apart from that, there's really not a lot of catalysts out there. Could come in the form, likely, of at least what's visible in the form of the RBI. When you look at Asia right now, it's uneventful. In fact, the verb I'm using today in our graphic is meandering this Wednesday. Volumes are on the lighter side of things. I think the only bits that are lifting the Asia-Pacific benchmark today are the gains we're seeing in Australia. But apart from that, as you can see, uneventful, if not cautious, to the downside, 0.7% to the downside here, as far as the Taiwan market is concerned. Right, going into the rest of things happening today, of course, we had some data coming through out of New Zealand this morning. I think we had the unemployment rate coming in as well, 59 cents, as you can see there in the Kiwi dollar. 2s and 10s, well, 10s and 10s, Australia and the U.S. Of course, we can get into the ISM numbers in a moment here, but certainly underscores the further softness that we are continuing to see out of the U.S. economy there. 147, let's call it 148 here on dollar yen. Very quickly, Golden Dragon Index overnight. We talked about earnings, right? So we are likely going to get some pressure going into the open today. We're down 0.6%. Yum China, big move to the downside. That's 6%. They didn't quite get to, not even close when you look at the new stores for the second quarter. About 120 stores short of what they were estimating there. BYD, and again, the mini meltdown we're seeing in EVs right now. BYD, NIO leading the declines overnight going into the open today. We didn't get a HIBOR setting, in fact, yesterday, so I think that was because of the weather. We'll get one today, and the one today will serve as a reference rate for the absence of Monday. A50 futures are pointing to the downside right now. Yeah, but so lots to watch, lots on deck today, Avril.
Yeah, you talked about earnings, you talked about the CGB sales, Hong Kong dollar weakness, and the HIBOR that we're keeping an eye out on, whether we get any confirmation about this potential Cathay order of Boeing jets. But worth noting as well what we saw in southbound flows just yesterday, net buying overall. The Shanghai Composite also rallied pretty hard, and we saw all sectors climbing. We'll, of course, be watching the brokerages as well. So, as you say, a lot to keep an eye on today.
Yeah,
and
there's
on
a ton
top
of
of
things.
that,
I think on top of what? Go ahead, Avril.
So we had that handover from Wall Street, right? Which was pretty negative given the services data. So how does this shape the Asia performance today?
I mean, we've been debating it this whole week, right, Avril? Like, we went into the Fed conversation. The rate cut probability has gone to 100%. We pulled back from that 88, 90% right now as I speak. And again, Quiet as far as the macro data was concerned overnight. It looks quiet with the exception of the RBI today, which we can get to in a moment. But yeah, I mean, the setup for today doesn't seem to be strong enough either way, which is perhaps why we're getting sideways trading, if not to the downside. Make no doubt the momentum in the last week and a half has really been to the downside. As far as most benchmarks go, we touched records. We almost pulled back from one overnight in the U.S. But yeah, the ISM services number, I mean, all things equal, stagnating services sector in the U.S., which I guess goes into the need for the Fed to maybe lean into the weakness even further. But again, we have a few more data points to get through before their next meeting. So that's still a guessing game. But you know, as our guest yesterday was pointing out, it does make sense to increase those probabilities going into the next meeting, Avril.
So what about China specifically for today? What are the stocks that we're going to be keeping extra close attention to?
Yeah, well, I was going to say Cathay Pacific, but they just wheeled Danny Lee in, so he'll talk about Cathay Pacific in a moment. That's an earnings story that's coming out today. I think Tencent's going to be interesting because of Tencent and Xiaomi, and similar reasons why. So that's number one and number three as far as weighting goes on MSCI China, right? I think number two is Alibaba. Both have actually been testing their highs. In terms of Xiaomi's case, they've been pushing towards a moving average. We get above that, we'll see. Tencent's actually been consolidating around 550. If that sees a breakout, and as you can see, that's really one stock that's divorced from the range-bound trade we've seen in other platform companies of late, that could actually lift the overall tide even further. Now, I bring up those two names as well because I was looking at the southbound flows over the last, let's call it 3 or 4 days. And yesterday, by the way, the most purchases on the part of mainland equity, mainland investors going back to April following a heavy net selling the day before, a lot of the money went to three things: Tencent, Xiaomi, and also some of the tracker funds. So some of the beta plays, which is why we are still getting the benchmarks, whether that's a Hang Seng Index or the Hang Seng China Index, actually bouncing off some key support levels. So those two things I'm tracking. BYD, obviously, we've talked about this. Macquarie will be joining us with their call on why the stock has yet to catch a bid, given how much it's already declined. We're now at 30%, give or take, from the highs. Yum China, that's an earnings story. And, of course, one other thing is InnoScience, which is a stock that's been all over the place, 30% up, 30% down, I think 6% down yesterday, also has been very, very actively traded across the stock connect, April.
And are we also seeing a sort of consumption theme or other themes that have re-emerged, I guess, from the Greater China area in the past week?
Yeah, so I think we talked about southbound flows, and suffice to say that's really one area we'll track as a leading indicator of where the market will tend to go. That's number one. HIBOR, I think, is something interesting because we've had interventions this week, right, out of the HKMA. We didn't quite get the setting yesterday. The black rainstorm warning effectively meant some banks, I think, were shut, so we didn't get a setting. We'll get one today unless the weather doesn't cooperate, and today's setting will obviously be the setting that would be used for yesterday. Apart from that, yeah, Shanghai Composite, I think you talked about that already. Where 3.5-year highs was the close as of yesterday.
And then, of course, the big one out of Asia today, as you alluded to also, is the RBI decision. I mean, a lot more for these central bankers to consider. I mean, what else are we watching out for in Indian markets then?
Yeah, I'm not ready for this RBI meeting. This is really where a lot of the big themes are intersecting. I mean, who would have thought we'd be talking about the RBI in the context of the White House and Russia, right? And, the path of rates on the RBI has been down anyway. I think we're down about 100 basis points on the repurchase rate from this time, I think in December. So we did a 25, 25, and 50. Market pricing suggests, or has priced in a further 25, either at this meeting or in the next one in October. Now, what's interesting is the split of economists. So a decent minority, we're talking about a third of economists that we've surveyed, actually think that cut is going to come today. The other interesting bit, which is related to that, on the tariff story and Donald Trump saying he might up tariffs on India over the next 24 hours. I think, for one, if the RBI had a choice to move the meeting, they probably would, just to get more certainty around tariffs. The Indian rupee, the worst performing emerging market currency since late last week. And I think MUFG said the RBI might actually intervene to keep that at about the 88 level. Yeah, so that's pretty much the market's agenda for today, I guess.
Yeah, and I think we saw it, the rupee hitting record lows just a day ago. And to your point, the RBI decision falls within Trump's 24-hour window. But let's also talk about Cathay, right? This big scoop we've gotten. Cathay poised to place an order for new jets from Boeing for the first time in 12 years. Our aviation reporter, Danny Lee, is with us now. So, Danny, talk to us about the size and scope potentially of this deal. What is it going to mean for Cathay, for Boeing?
Yeah, this is going to be a substantial order for Boeing and a real win for Boeing, being handed an order from Cathay. And over the last several years, Boeing has lost a series of order opportunities to Airbus. So this is significant, and it marks a real comeback after multiple years here. And what we are hearing is that Cathay is looking to order additional 777 aircraft, the 777X, which is still going under certification. And so this is really to underscore Cathay's longer-term expansion and ambitions. But the undercurrents of all of this comes at a time when, for example, Airbus was supposed to win a large amount of orders from Chinese carriers, and it never materialized because of this kind of strain on ties between China and Europe. But now Cathay's come in with a big order boost, potentially, from what we understand, for Boeing aircraft. So, yeah, there's sorts of different undercurrents. Great for Hong Kong, great for Cathay, great for Boeing, but also just the potential politicization of all of this as well.
Danny, what does this mean for the program itself, the 777X program of Boeing?
For the 777X, so Cathay was already one of the earliest airlines to buy into the 777X program. So this really underscores the confidence that major customers have in the 777X program, and also just the fact for a traditional customer of Boeing's, like Cathay, by making that repeat order, finally, given Hong Kong and Hong Kong International Airport has expanded. So for Cathay, they really need to maintain that market share into the next decade. And how they do that, they're going to add some Boeing aircraft on top. They've already got over 100 Airbus aircraft on order. So there's some share now for Boeing.
Danny, thank you so much. Danny Lee there with the scoop. On deck, of course, as far as earnings go today, Cathay Pacific. And we'll have certainly more on Cathay Pacific itself. We have our equities team, in fact, covering the stock itself. And as Averill was pointing out, this is a stock that's gone up 50% over the last 12 months. And we will ask Averill whether that can actually keep going.
I'm not sure I have the answer to that question, but what I can tell you is how we will try and digest in terms of how significant this Boeing order is for Cathay if we get some form of a confirmation. But certainly to Danny's point about how these deals or Boeing orders potentially have been increasingly politicized. In the meantime, the U.S. president also threatening to increase tariffs on countries buying energy from Russia. This includes China, and this is, as we've been mentioning, after he already said he would raise levies on India within 24 hours. A Bloomberg News Desk editor, Jill Deeses, is with us for this. Jill, break it down for us. I mean, what is the state of play when it comes to importers of Russian energy? What kind of tariffs could they be facing?
Yes, Averill, there's such an interesting, I think, dichotomy between India and China on this issue in particular. So as you mentioned, and as we've known, Trump has really kind of ratcheted up rhetoric on India in particular, slapping those 25% tariffs on India, now threatening to go even higher because this all, apparently factors into the pressure that Trump is trying to build on Russian President Vladimir Putin to end the war in Ukraine. That's by, applying these secondary sanctions or tariffs on these buyers of Russian oil, obviously, as you mentioned, including India and China. We don't know how high those tariffs could go. Trump has just recently said, he doesn't really have a number in mind, or maybe, he hasn't really said a number out loud, but, just a few weeks ago, he was floating tariffs as high as 50%, 100% on, trying to impact those countries. So we'll kind of see where that that goes. But again, that threat being very real there. That, though, in contrast to the language that he's been using on China a bit, where, certainly that threat does seem to exist. But at the same time, it does seem like the U.S. is very, very adamant about trying to, further this, increasing this pause on the U.S.-China tariff situation that could potentially be extended for another 90 days or so. So, yeah, I mean, very fluid situation, but obviously, quite a lot going on when it comes to how these tariff negotiations work with both the U.S. on India and on China.
Yeah, and speaking of something that is getting extended, this favorite sort of cadence of time, 2 weeks, right? A week or so, I think, is what the U.S. president used for pharma and tariffs there.
Yes, that's right, David. So I think that what we're waiting to see when it comes to pharmaceuticals is what that initial tariff ultimately looks like, because what Trump has been saying is that he thinks there would be what he characterizes as a low tariff on pharmaceutical goods to start. Although, when it comes to Trump, when we're dealing with, a global baseline of 10-15%, obviously we have to see what that looks like. But then what he says is after a year or so, he would expect that to ratchet up to 150%, 250%, tariffs on pharmaceutical goods. I mean, we're looking at really astronomical numbers here. All of this part of his pledge to bring, this production back to the United States. We'll see how that goes. But I do want to point out that particularly if you're India right now, looking at, in addition to all these other tariffs that Trump is threatening or even just applying, an additional tariff on pharmaceutical goods, obviously not particularly good news there. And unlike China, which does have that leverage of that rare earth situation where I think they have a little bit more negotiating power when it comes to working with the U.S., India doesn't really have that. I mean, they've got Donald Trump coming out, slamming their economy as being dead. I mean, truly kind of an insult there. So I think that if you're India in this specific situation, it's a really difficult predicament to be in.
Yeah, and there we go. As Jill was pointing out, the road leads back to the RBI today. Jill, thank you so much. Jill Dees is there, our news desk editor. Counting down to the open of trade in Shanghai and Shenzhen and here in Hong Kong. A look at the weather outside right now where we're coming off and still, by the way, battling some very bad weather out there. The Hong Kong Observatory has now put out some guidance that they do expect thundery showers, and you see their phrasing here, to start affecting Hong Kong in the morning. Showers will be heavy at times, thunderstorms around noon. So again, brace yourself for some fairly strong weather today. 13 minutes of the opening bell. This is the China Show.
Welcome back. You're watching The China Show. Let's get you up to speed with the Yuan fix. As we know, the PBOC has been steadily trying to guide the renminbi a bit stronger. And earlier in the week, we saw it below the 714 level Monday, Tuesday. Today, the fix above that. We're seeing 714.09 as the reference rate. So, maybe a bit to do with what we saw in the dollar overnight, David.
Yeah. The dollar story is still actually quite wanting as far as direction goes. We're still in the midst of a technical bounce. I mean, you could call it some support, but yeah, all roads do lead to pointing to at least dollar weakness moving forward, particularly if the Fed gets going. Anyway, we can table that for now. The other big story we're tracking here today, Taiwan prosecutors have arrested 6 people suspected of stealing trade secrets from TSMC, sparking this investigation into what really could be a serious breach of national security. Min Lo, our China correspondent, is here with us to talk us through this. Is coming amid this tightening of the tech race between the two, and certainly that's the context. What do we know about this story here?
Yeah, so Taiwanese authorities had they are arrested these 6 people actually, and they have searched their homes. We know that FT reported that authorities had separately also searched the premises of Tokyo Electron in Taiwan. This is a company that has been selling a lot of these equipments to TSMC. The missing answer now is, what is the end goal of these people who stole the technology? Who are they supplying the information to? Authorities are still finding out if the information stolen had been leaked to any third parties. But we know Nikkei had previously reported that TSMC had fired some employees over suspicion that they're trying to steal technology related to the 2-nanometer chips. And these are the most cutting-edge chips that TSMC can now manufacture. They're planning to mass produce that by the second half of the year. And you think about who might want to get their hands on this technology, right? Actually, a long list of companies, including, for example, SMIC, the Chinese counterpart that is now still only able to produce 7 nanometers chips, but also other rivals of TSMC, including Intel, that is trying to catch up as well. So a lot of questions here. Of course, the big context here is that Taiwan is still also trying to negotiate for lower tariffs from the U.S. Is this part of measures to try to, appease the U.S. concerns around security, national security when it comes to chips exports as well?
Yeah, Min, when it comes to exports out of the U.S., NVIDIA chips comes to mind, right? And we're also seeing how the U.S. is charging to Chinese nationals for an export control breach of those chips.
Yes, chips really is at the center of this tug of war between the two nations, and these two Chinese nationals are being charged. They're accused of sending tens of millions of dollars worth of NVIDIA chips to China without acquiring the proper licenses for them. Again, this is coming at the center of, trade talks that are still ongoing, with President Trump yet to announce an extension of trade truce. This comes as China, on its part, had also expressed concerns over the usage of NVIDIA chips, citing the Trump administration's call to install these location tracking capabilities in the chips to ensure that they don't fall into the wrong hands. So certainly this latest charges on these two Chinese nationals reportedly sending chips illegally to China via Malaysia, this is going to further derail those talks that are ongoing as well.
Min, thank you so much. Min Lo, our China correspondent there. About 7 minutes to the opening bell here. Hang Seng Index lower going into today, and we're looking at a couple of things. Tencent, BYD, we talked about that. We're lower in the pre-market again, 1%. This now takes the 14-day RSI to below 30 for the first time in about a year. So that's one stock we're tracking. Apart from that, we'll tell you about everything else on the other side of this break. This is the China Show. Good morning.
We're back with another scoop for you, this time relation to OpenAI. It's said to be in talks for a share sale that would value the startup at $500 billion. So we're hearing that it is in early talks about a potential secondary sale of stock, and this could be for current and former employees, and that would take us to that valuation, as I said, of about $500 billion, and this is according to people familiar with the matter. The company is targeting the stock sale in the billions of dollars. So certainly something we're keeping tabs on, David.
Yeah, $500 billion would be just ahead of Netflix in terms of just the market cap. So that's actually within now. $500 billion buys you a ticket to within, to be among the 20 largest companies in the world on market cap, of course. Not to mention there might be other private companies. But yes, substantial valuation there. Right, going into, and speaking of tech and chips is one level, one area. We're watching the equity markets today. As you can see on your screens, you had AMD, of course, and some of the guidance coming to us pertains to the Chinese market. Yum China out with earnings. The U.S. markets reacted already. We're going out today 6% to the downside. The open is next. Welcome back. You're watching the China Show. You know what? To be completely honest, I am sick and tired of this weather that we're going through here in Hong Kong. And it's looking like, again, another day of thunderstorms. You look at the weather forecast out there. But at least, here's the thing, at least we are sheltered, we have clothes on, we're not hungry. Just to put your problems into context for you. Avril.
Yeah, nice to put things into perspective. I don't really have much to add on that, actually. Always thankful, always blessed.
Yeah.
But maybe we can
grateful.
We can kind of recenter
grateful.
the conversation. Yes. To what we're seeing potentially in markets today. I guess that's a sign of the times, right? What do we have? Watching out for still. I think I've said this all of the past week. Watching out for whether we see an extension of the U.S.-China trade truce. In spite of that, though, that absence of that, we actually got a pretty decent bounce on the Shanghai Comp just a day ago to the highest in 3.5 years, I believe it was, and the climb was the strongest since late June. So perhaps unsurprising, we're seeing a bit of a reversal today, not by much though, just sitting a bit softer. Worth noting that we're continuing to track some of these brokerages in relation to what we're seeing out of their overseas performances. But aside from that, keeping tabs also on the consumer themes. We did get some of those earnings, and I think if there's any upside from these price wars, intense competition out of the mainland, it's helped Yum China do pretty well. That boost in profits because of some of these lower delivery prices on the platforms. We'll take a look at the Yum China stock in just a bit, but we can also take a look at how the Hang Seng is faring overall. We did get a negative handover from Wall Street, no thanks to the U.S. services data, and that's really starting to show the tariff impact creeping in to the American economy, right? A lot of the economists that we've been talking to say ultimately, you got some of these Asian exporters and U.S. importers bearing the brunt of it, but ultimately at the end of the day, it's going to be about the U.S. bearing the majority of that. So interesting to see. We're seeing it quite flat on Hang Seng as well. Tech is down. Aside from that, take a look at Yum China. I think we can pull out how it's performing following its earnings. There you go. 5.5% down, and this is despite the beats in estimate. We'll try to unpack that story a bit further for you. And of course, as we keep a lookout for the impact from sectoral tariffs from Trump, one of the key sectors after autos, after steel, aluminium, we are keeping close watch on chips and farmers as well. So let's take a look at China farmer stocks. Trump has said, right, might not be 150%, might go up to 250%. What is this going to mean for the cost of doing business and import-exports overall? So interesting to see as well. Farmer Resources Shanghai, one of these stocks we're watching out of the mainland, surging ahead, 12% higher. But chip stocks, that's the other bit that we're focusing on today, David.
Yes, we're looking at that because of the AMD earnings and the guidance, or lack of clarity, I guess, when it comes to that as well. Just to clarify, we showed you guys, can we just come off this a little bit first, because this this Goldman Sachs note, just to clarify this, because we showed that to you a moment ago, just to clarify that. So GS put out a note talking about delivery platforms and how elevated subsidies among those platforms might actually mean a potential earnings upside for freshly made drinks names. There we go. So I think the way the graphic bottom of the screens was phrased was perhaps not ideal and not. So we're talking about mostly it looks like the bubble tea makers. Yes. Anyway, that clarifies that specific note is concerned, which I'm now scratching my head why we're doing that. Anyway, okay. You don't want to get in here. Let's talk about chips. There we go. AMD, out with profit. Shares actually fell in post-market trading. It did warn of this return to the crucial Chinese market remains a work in progress. It's overshadowed gently upbeat's forecast for its AI business. So you had negative, but you also had a positive angle coming through as well. Chip makers on the screens here in the Asia Pacific. Masahiro Wakasugi is with us, our Bloomberg Intelligence senior analyst. Masahiro, good morning, and thanks for waiting around and talking to us today. What was the key takeaway for you here?
Good morning. Yes, if we look at the AMD's results, numbers look themselves quite good. And in the conference call, we are seeing that some kind of discussion about AMD's growth story going forward. And the market should be focusing on the AMD's GPU products revenue growth story. And I think that AMD is pretty confident about its growth story over the next year or two. And analyst in the conference call was asking that if the AI GPU revenue can reach $7 billion in 2025, after hitting around maybe over $4 billion last year. But AMD was not mentioning the exact specific numbers, so still maybe the market might be a little bit concerned about tough competition against NVIDIA, and NVIDIA's GPU revenue are trending way higher than AMD's. So still, market maybe a little bit skeptical about AMD's growth story going forward.
What about the Supermicro growth story? We see it cutting its annual sales forecast as well.
Yes, if we look at Supermicro's earnings, and its next fiscal year's revenue guidance was they were pretty much like they say that above maybe 33 billion US dollars maybe. And in the past, the company was talking about a bit higher numbers than their current forecast for the 2026 fiscal year. So maybe the number was a little bit disappointing in the market, and we think that it's a kind of the company-specific event. So at the same time, we saw some other companies reported that this morning, including Arista Networks, and Arista Networks supplies its products to the they call it the AI Titan, and including probably Meta or some other hyper-scale cloud providers. And the numbers pretty good. So we can say that the AI investment environment should be trading quite nicely at this point. So I think that the Supermicro situation seems to be quite company-specific.
Masahiro, thank you so much. Masahiro Wakasugi, our Bloomberg Intelligence senior analyst there for technology on the big earnings, of course, which came out overnight. And, we're coming off most already. We're going into NVIDIA, which is the big one as well. The reason I bring that up is U.S. earnings have been a decent driver, a main driver, if you will, of U.S. equity markets, which up until the last 24 hours was pushing towards a new record. We pulled back from the edge. Marcella Chow is here with us on set, global market strategist at JPMorgan Asset Management. Good morning and nice to see you. Start off with U.S. earnings.
Sure.
What do you make so far?
Right now, we actually see year-to-date consensus actually has been beating consensus. So right now, we're expecting 2025 to reach around 7.7%, which is actually much higher than the 10-year median average of 5.5%. And it's mainly led by revenue growth, and particularly within communication services and also technology and also financials. So all through first half of this year, market has been worried about the tariff risk. We continue to believe this will be a risk going forward. But then so far, the impact seems to be relatively muted, probably because companies that within guidance, we see that they have been adapting with their mitigation strategies after learning from, for example, COVID and also the pandemic and also like the previous inflation spike back in 2022. And so we continue to believe that will still be a risk, but so far it's relatively muted in terms of the earnings. And then we see consumer discretionary actually seems to suggest that consumers are still relatively resilient within the economy as well. So yes, we see the labor report has been weakening, and then the economy is cooling down. But then from the earnings report, it's actually quite encouraging.
Yeah, I was actually going to ask you about that. I'm glad you brought it up because the timing of when the earnings came out also came at the same time we started to get softer U.S. economic data. Do you think earnings will continue to remain somewhat resilient or divorced from what looks to be a slowdown that's coming in the U.S. economy?
Well, right now, we continue to see earnings should be able to continue to deliver at least for the second quarter. For the second half of this year, we continue to see risk potentially from tariff, etc. But then on the labor market report, etc., we will also need to monitor, for example, upcoming before the September decision, whether there'll be 2 more inflation reports and also another job report. So those are the ones that we'll continue to monitor as well.
So what's the plan for the rest of the year, Marcella? Do you buy Mag 6s and then maybe stay away from the sectors that are a bit more tariff exposed?
Yes, domestically oriented ones and also that are more immune to, for example, potential tariff uncertainties. Those are sectors that we continue to like. We continue within U.S. equities, actually, we see value within, for example, AI once again. Early in the year, market was worried about the AI and also U.S. exceptionalism. But right now we see actually AI continues to be like giving out gifts. Like we see hundreds and billions of investment into infrastructure and talent. Let us continue to play out in terms of, for example, the data center, in terms of the cloud computing, AI and its adoption rate, and it's actually broadening out not just within communication services and like IT, but also into utilities and into, for example, various other sectors like consumer discretionary, where companies are actually using AI to hire new staff, etc. So this is actually adopted broader across sectors and actually benefiting various sectors as well. And also with potentially US dollar weakening as US economy cools down, we see value into or actually interest back into Asia. And as more clients have been also asking about Asian equities value, which we remain quite constructive on.
How would you sort of include these potentially higher tariffs, particularly on chips, right, into what we see on the costs of AI build out for some of these US tech names?
Indeed. We see, for example, the this will probably with the semiconductors and also other sectoral tariffs that will continue to impact, for example, the development of AI possibly within Asian economies. But we see that they do have a cutting edge in terms of development and infrastructure. So that's why at the beginning of this year, there was the resurgence of, for example, soft tech, with DeepSeek, etc. And gradually, as AI continues to evolve, we see also the demand back into like hard tech, hardware. So that's why we see the outperformance in Korea and Taiwan. So those export-oriented economies might continue to be underperform due to like export orientation. But then we see because of the cutting-edge development and technology, those will also continue to benefit. And within Asia, given how there's a strong internal consumer impulse, so there are economies that will continue to benefit, like Indonesia, Thailand from tourism, etc. So we'll balance between the export-oriented economies and also the domestically oriented ones to strike a better balanced portfolio.
Okay, where does this leave China? Just very quickly, Marcella.
Indeed. Right now, we see that the data has been relatively mixed in terms of macro outlook. But then we see actually within China, we actually suggest a barbell strategy in terms of the offshore ones, where we initiate this term called TEA, where T is like technology and also the IP development or globalization of biotechnology and also, for example, in entertainment business with movies, etc. And E with the experiences, personal experiences of various instant gratification of this new Gen Z generation, and also with affordable luxuries within consumer discretionary. And meanwhile, on the onshore, we actually remain constructive on those for the high dividend stocks, given its resilience to potential volatility and market uncertainty going ahead.
Marcella, Chow, thank you so much. Global market strategist there at JPMorgan Asset Management, braving the weather, coming in here to see us, of course, here in our studios today. Coming up, we'll take a closer look at BYD, the world's biggest EV maker. Can't seem to catch a break. Stock is down again, 1.5%. We're now trading at 110 Hong Kong dollars a pop. Eugene Hsiao joins us in a couple of minutes to talk us through, do you buy the BYD dip? Do you catch a BYD bid? This is Bloomberg. Welcome back. We're looking at shares of BYD. Broadly speaking, of course, EVs, the leading EV maker. Is competition really eating away at, the outlook, right? When you look at the monthly numbers, it's certainly shown that in order to get to the annual target, it will need to deliver quite a substantial second half of the calendar year. Stock, as you can see, is now trading at 110. It's below the 200-day moving average. A measure of technicals indicating the stock is oversold for the first time in about a year or so. That's about a 30% drawdown on the share price itself. So I guess that's a simple question. Do you buy the BYD dip, Avril?
Yeah, good question. And I think we're going to discuss that with our next guest, who has an outperform rating on BYD and sees the company shifting to a value for money strategy through the rest of this year. Eugene Hsiao is head of China Equity Strategy at Macquarie Capital. So, Eugene, we'll get to your price target and whether we should be buying the dip at this point. But, as David was alluding to, with these July numbers, is it getting increasingly difficult? Do you think BYD is going to meet its annual sales target?
The short answer to that is no. We've actually recently cut our annual forecast for the volumes that are going to be sold this year. Right now, the company is guiding for 5.5 million units, including overseas. The overseas number is very strong. We do think that there is scope for them to be ahead of their expectations. But of course, as David just mentioned, the domestic sales have been weaker than expected. And that's primarily due to this very strong competitive dynamic this year we've seen in China in the mass market for EVs.
Very strong overseas. So does that include, I guess, Europe? What are you seeing in terms of that shakeup or sort of competition with Tesla?
At the moment, we don't see BYD as a head-to-head competitor with Tesla. I think right now the strategy overseas is to be a bit more broad-based. Clearly, they're entering into as many geographies as they can get into, not just Europe, of course, including LATAM, ASEAN, Australia, of course, and Macquarie included. So you can sort of see that this is a strategy which is much broader than Tesla's, and the price points are going to be much wider. So, for instance, recently in Europe, they've launched a car called the Dolphin Surf, which is a variant of the Seagull model that's very popular in China, and that's at a much lower price point than most Teslas.
Right. And Eugene, at what point, David here, by the way, at what point do you think the stock becomes really a proxy for its global ambitions rather than competition domestically?
I think at this point, most people are aware of BYD's global ambitions. And when we think about the investor base, this is a very large liquid stock, and there's a lot of global investors that already own the shares, most notably Berkshire Hathaway, of course. And I think that when we're thinking about the longer-term growth trajectory for BYD, it is mostly going to be dependent on the overseas market. So it's a very something that people are trying to price in right now. But as I think we alluded to earlier, there are a lot of risks around the geopolitics, of course, and that's weighed on the stock a bit as well.
Right. Do you think I think one of the things I want to bring up and hoping you could elaborate on this, one of the things you point out is this anti-involution policy overhang, which I guess alludes to your note on competition there, will resolve in about 1 or 2 months. In what form do you think it will? How do we know it's being resolved effectively?
Yeah, I think when you look at the actual share price of BYD, it reached a peak, I think, around mid-May, and it's declined fairly sharply since then. That's coincided with a couple things. I think first, we've seen the volume slowing down, which you've just discussed. But also at that time, there was a lot of commentary about this excess competition in the Chinese EV markets. And I think that has also weighed on BYD shares because it looks like the government is trying to tighten the marketing practices of a lot of these EV companies in China, which is a near-term headwind. I do think that goes away. And the main reason for that is because EVs will remain a priority sector for the Chinese government. I don't see any reason for that to change. And that's why I think once they sort of sort out some of these near-term sales practices, be it payments to suppliers or how they pay dealers on time, et cetera, once that gets all sorted out, I do think that the regulatory overhang will lift.
Near-term, among the EV players, which ones do you see better placed or positioned to preserve their sales, their margins?
I think when you're thinking about it, generally speaking, there's two things that you really want. The first, of course, is volume, so you can get the scale, and that will help to drive margins. The second, of course, is price. Price has been the hardest thing in China. In the near term, the best performing companies in terms of fundamentals have been names like Li Auto, names like Xiaomi, for instance, that sell quite more expensive car. When you think about the price points here, you're looking at like a US dollar $35,000, maybe $40,000 car versus your typical BYD, which is like a $15,000, $20,000 car. However, BYD has remained very profitable, mostly because of their scale, their volume, their cost advantage. We don't think that changes. We think that's an enduring competitive moat for the company, which is why we're still outperform rated on this name.
Yeah, so talk to us about that price target. What's the thinking behind that a bit further?
I do think that this company has a lot of levers they can pull, especially into the second half of the year. While we did recently lower our volume expectations, I think that BYD is looking for different strategies they can adopt in order to help lift their volumes for the second half. For example, last week they just launched a variant of one of the more popular compact SUVs that doesn't include the ADAS system. So it's sold at a 25% lower price. I think that's very attractive for consumers right now that are very price sensitive in China.
Eugene, very quickly, in 20 seconds or so, stock split, share price is lower. Do you think retail investors will come in and be attracted by that corporate action a few weeks ago?
I think for the H share, we've seen it happen already. The A has been very recent, so that's probably less so. But overall, I think it's already in the shares.
Fantastic. Eugene, have a great rest of your Wednesday week ahead. Eugene Hsiao, the head of China Equity Strategy at Macquarie Capital. Right, plenty more ahead here on The China Show.
Let's take a look at markets. Yum China, as we've been mentioning, is one of the stocks we're watching really closely, falling as much as 6% in Hong Kong earlier. This is tracking the declines in the U.S. stocks after, we saw that prudent sales guidance. Morgan Stanley, though, saying that this correction appears overdone. We did, after all, see it beating estimates because this delivery war in China has been helping it to boost sales via some of these lower platform fees. I guess that's one way of looking at it. So down still on the stock, but as I said, Morgan Stanley sees that as overdone a correction. China baby stocks, that's up on your screens, and we're seeing that climbing as well. They're in focus because of this free preschool education plan among the stocks that we've been watching in the session today. Welcome back to the second hour of the China Show. Here's a look at the Hang Seng half hour into the session. Actually not giving us that much direction despite that bounce from a day ago. I guess this is upside if you're considering how Wall Street performed. We saw that U.S. services activity number also raising concerns. These cracks increasingly showing up in the U.S. economy. So a lot to consider when it comes to trade today.
Yeah, certainly a lot. And, so we went from the jobs number to the ISM, and then we have a couple of more, I think, inflation and job sprints coming through before the next Fed decision. Plus, of course, we might get someone new at the Fed as well, right? So there's lots to consider as we sort of go through that conversation. The other thing I'd mention, too, as we look at the other things in the market today was the fix and the reaction that we did see to the upside on dollar China. That's point number one. In terms of the earnings theme today, decently busy as far as South Korea and some Japanese names are concerned. Not too high up as far as market cap weighting is concerned. Decently long list is, just to clarify, of course, what I meant by that. Apart from that, it's really about the RBI, which we can get to in a moment here, and, of course, the tariff conversation, which today is coming in the form of two things. One is India, what it means for the RBI, their energy reliance, or what they're doing, energy strategy, as it pertains to Russian imports. The other thing is on pharma, and Donald Trump saying that chip and pharma tariffs are coming in the next week or so, Avro.
Yeah, to your point, I think India is really feeling the heat, the price they're paying on their reliance from Russian oil imports. And Trump is, making no apologies at this stage, really going after buyers of Russian crude or energy for that matter. So that includes both India, that includes China as well. But to your point as well, on sectoral tariffs, this is something that the economists we've been speaking to, or the macro strategists we've been speaking to all of this week, have been saying to watch out for, right? After we get these levies on these countries, it's about the specific sectors. He's put in place tariffs already on cars, steel, aluminium. So now we're watching out for farmers and chips.
Yeah, and really what the when Donald Trump says it might be on the low side of things, again, calibrate your lenses, right? 10%, 10 to 15% is certainly something to watch. And I think that goes into the RBI, to your point, right, where it's usually a non-event as far as plot lines are concerned for the RBI. It was fairly straightforward, right? There was a case to cut. There's certainly been a case to ease interest rates, where I think we're down about 100 basis points from, we had 125, 125, and a 50. And then there's still a 25 left that's still priced in. And the question is, do we get it today or do we get it at the next meeting? And that actually, how that's changed within those two meetings is because of what's taking place in tariffs. A sizable minority, we're talking about roughly 30% of the economists surveyed, actually think that rate cut comes today. So we'll see what happens with that. The currency, of course, is the worst performing EM currency since late last week. MUFJ thinks the RBI will actually intervene at 88 to cap it at 88. Anyway, we can talk about India a bit later on. But yes, it's certainly something that we're tracking over the next few hours or so. Avril.
Yeah, in the meantime, let's unpack that tariff story a bit further. Our senior editor, Bill Ferries, joins us. So, Bill, Trump's saying a lot when it comes to potentially India and China, how they might get hit with higher tariffs. Is he treating India differently than he might be treating China, though, all things considered?
It certainly seems that way. I mean, this downward spiral we've seen in the U.S.-India relationship is not something I think anyone expected, say, 5 or 6 months ago when Trump took office. He and Modi had a very good relationship in his first term, and it looked to be going that way in the second term. His focus in recent weeks on India has been quite harsh. He's threatened, he's put that 25% tariff on to begin with, which was higher than most countries. He's talking about increasing that and also hitting the pharmaceutical sector, which is an important export market for India. India imports about 1.7 million barrels a day of Russian crude. China imports about 2 million barrels a day, but we don't see that same kind of rhetorical warfare against China. Trump even saying that he thinks he's close to perhaps extending this truce he has with China and going forward. So it's possible China might get hit with additional tariffs as well when all is said and done in the next several hours or days when Trump comes out. But right now he's definitely directing his anger much more at India than Beijing.
Yeah, the ire is clear. What about sectoral tariffs? I mean, we could see pharma tariffs go up to as high as 250%. What should we realistically be expecting for sector-specific levies?
Yeah, it's a huge open question right now. I mean, we're talking about pharmaceuticals, we're talking about semiconductors. The administration previously signaled that while the pharmaceutical tariffs could be high, they could jump up to a couple 100%, that their inclination was to start low. What does low mean? I don't think anybody has anyone has a clear idea of that right now. But the idea was perhaps phase them in over time, over a year or two, give companies time to set up some more production in the United States. But it's what Donald Trump considers low may not be what the markets or what companies or governments consider to be low.
To your point earlier about how he might be treating China a little bit differently now, what does this mean about the odds for a Trump-Xi summit or U.S.-China trade talks? How are they progressing?
Well, he said that he basically wants to meet Xi Jinping to help sign that deal. So he wants to have more of a comprehensive agreement that justifies him either going to Beijing or the two leaders meeting somewhere else. There's definitely an interest on Donald Trump's part, but he's a deal maker. He wants to have a big ceremony, and there's going to be a lot of big issues to work through before we get to that point.
Bill, thanks for helping us unpack all that. Bill Ferries, Bloomberg senior editor. David.
Yeah, let's continue the conversation with Natixis Alicia Garcia Herrero, Chief Asia-Pacific Economist, is with us right now to help us understand the broader and longer-term implications. Now that, Alicia, good morning, by the way, now that we're starting to see the tariff fence form. I know you guys held a webinar yesterday for your clients. I got an invite. Sorry, I couldn't attend that. But yes, help us understand what we need to be thinking about next here, Alicia.
Well, what is next is, of course, sectoral tariffs that may change the picture. We have kind of a nice picture for Japan and South Korea, thanks to big tickets, investment in the U.S., all the way to 550 and 350 billion, respectively, Japan and South Korea. So those tickets, have they bought? That's the question. Have they bought exemptions? They bought exemptions on the autos because they were already there. But what about semiconductors? Same thing with pharmaceutical and Europe. Have we bought that ticket? We don't know. So, that's a big one. Talking about tickets, let's talk also about transshipping tickets. Yeah. Who has bought that ticket? We know Vietnam is basically nailed on 40% transshipping tariffs. But what about the others? According to Trump, everybody will go through that, but we've not really seen the details. So in that regard, we don't really know where each of these countries really stand at the end of this route, because we've only had basically part of the picture. Reciprocal, but the rest is very important. So on your question, I think we really can't yet say who is the winner, who is the loser.
And it's degrees of confidence if your company is trying to figure out first if you'll spend really to rejig your supply chain. And in a few months we'll be 25% done with Donald Trump's second term, and in 3 years that's a fairly quick period of time. By the time you're finished moving your factory, the tariff conversation might be different. What advice do you have for companies now needing to think about their supply chains, Alicia?
So so a piece of evidence and an advice. The first piece of evidence that kind of brings me to my advice is that if you look at the investment announcements, foreign direct investment of companies in the world, they're all trailing towards the US. So Samsung, Hyundai, Sanofi, a lot of pharmaceutical companies, Swiss pharmaceutical companies, even if Switzerland has also been really hurt massively with the final deal on tariffs. But they seem to believe tariffs will be high. That's my point. Why? Because they are making announcements to basically operate in the US. Much less so when you look at investments into Asia. And this is not China. China, we know that foreign direct investment has been, down and down since COVID, basically. But what about the rest of Asia? They were receiving huge amounts of investment, in a way, partially from China to bypass Trump 1.0 tariffs. But this is not happening anymore if you look at the announcements. So the question is, will we have for companies a strategy that will move beyond China +1 to Asia +1, i.e. Asia is not safe any longer, at least as far as the US market is concerned. So, this is really the key question. Is the whole Asia Pact, and when I talk about Asia, let's put aside India. I heard what you said. I mean, it's not a done deal. Let's see what happens, because I think the US does need India, and there may be a compromise there. But Southeast Asia, that's a China-centric supply chain. So for me, given the level of tariffs, again, and also the transshipping that may actually affect the whole region, not only Vietnam, that's quite clear. We don't know the level, though. That's too much of a tariff wall to continue to invest in Southeast Asia to bypass the China-centric tariffs that we had before. So this is a big change for supply chains within Asia.
What about integration of trade among the Southeast Asian countries? If we say take China out of the equation, what are you seeing there?
Well, that's a great question, Avery, because for me, there's two things happening. First, as I said, Asia +1, meaning if I'm a Western or a US or a European manufacturer producing in Southeast Asia for the Western markets, maybe that's not something I'm going to pursue further. Tariffs is the reason. And I also need to invest in the US because I've been asked to invest in the US. But what if I'm a Chinese manufacturer? What do I do elsewhere if anyway I'm going to be chased in a way or another? Shouldn't I continue to invest in Southeast Asia and in a way transform, enhance the existing supply chain to serve the rest of the world? That is the global South. And big question mark, will that also be Europe? Because if that Europe is included in the second equation, in the existing, basically, China-centric supply chain in Southeast Asia, I think Southeast Asia will continue to flourish because that's big enough. Of course, it's not the whole pie as it used to have, but it's big enough. So Europe is actually very important in this equation. And that's why we need to really focus on whether Europe is going to put more barriers on China, but also is going to follow the US in the transshipping story, because that would change the picture enormously negatively. But this is unlikely, very unlikely.
You talk about Global South. Let's focus on India. I mean, the RBI decision may be complicated because of Trump's 24-hour tariff window. But before we talk about what we might see of the RBI today, what is your sense of maybe some of the longer-term structural shifts that India has been trying to engage in? How is this tariff growth trajectory affecting things?
Well, long story short, because it's such a good question, but I think it boils down to China needing manufacturing FDI. We know this since the elections. I think this is really very much behind the lack of, good jobs, manufacturing jobs, and the discontent. Now, I think Modi got the message and felt and kind of explored three venues: Kazan, BRICS Summit, knocking at China's door, but of course with a lot of constraints. Modi cannot offer everything to China. We had Xi in, but a lot of the other deals, BYD, it's just not really happening in the way that maybe Modi would have liked in terms of job creation. But there's this big China thing in India, and it's very hard to change. Then we had Scholz visit in October 2024, the German manufacturers coming to India. It hasn't happened. Really not. They're stuck in China. They're just continuing to invest in China. And I think they're not seeing India as the next market yet. And then the US deal, this kind of, accelerated when Trump won the elections. And we had like a peak in March. And then we thought we were going to have a deal beyond the tariff. I mean, like a big opening of the Indian market to US companies to manufacture in India. It hasn't happened. So what is Modi going to do now? Where is he going to get this FDI? Given the level of tariffs, even worse, that this is making things very difficult, because even a European manufacturer may want to go to India to export to the US. So, I think India needs to solve this problem. If it's at the cost, and I saw the estimates, it's really barely 0.2% of GDP additional cost if they switch from Russian oil to elsewhere. So I know geopolitically it's costly for India, but I think they need to go for it.
Alicia, just to, I guess, wrap up the conversation with a look at the here and now as far as India goes, and, the rate decision today, and this might not just be an India question, by the way, is the case for lower rates as concrete and as clear now for India and other parts of EM Asia as it's been? In other words, do we get much lower rates ahead the next 6 months? Let's call it that.
Well, had you asked me this question before Friday, I would have said yes, because, we had the strong dollar, tariffs were pushing currencies, and, it was all about making room to export. Yeah, I mean, making room, and especially if China gets a better deal. So that, for me, it was a weaker currencies and central banks helping, including India, for other reasons. But overall, yes. But, now we're seeing a weakening of data. US data, a much more fragile, if you want, even institutional framework because of what's going on with the Fed, you name it. So that turning the dollar may actually soften, if you want, the pressure on these currencies and therefore also the pressure on central banks to cut rates further.
Alicia, really great to chat with you. Thanks for your analysis. Alicia Garcia Herrero, Chief Asia Pacific Economist at Natixis for us. And still ahead on the China show, Trump's tariff shock is putting pressure on India's central bank, which is set to announce its rate decision Wednesday. Will break down what's at stake. This is Bloomberg.
Right. on your screens right now, well, here on my right, Kids Want Children products, 1.5%. Being Mates, 3.8%. If you're unfamiliar with these names, these are some companies that cater to the baby or child economy, if you will. Xinhua News reporting yesterday that the government is planning to gradually roll out, get this, free preschool education. Min Min Lo, our China correspondent, is here with us to take us through what the Xinhua report was and how this will be implemented, Min Min.
Yes, this was actually announced during the 2 sessions in March this year. The government announced the intention, or at least the goal, to provide free preschool education. And now we're starting to see the measures being gradually rolled out. And among them include, for example, getting preschools, public preschools, to offer free tuition fees for final year students starting from the fall of 2025, so this year. And also getting private preschools to lower the fees in line with public standards. Provinces are being asked to provide more support for disadvantaged students. The government also considering providing subsidies as well. We know from local reports that the central government will be funding most of this, providing about 50 to 80% of the funding costs for provinces, and it could benefit as many as 10 million kids. And this is coming as part of a broader series of measures that we have been hearing recently, right? There had been recent announcements of childcare subsidies for kids under 3 years old. Beijing, for example, also announcing that it would start to include assisted medical technology into medical insurance. So all part of measures to try to boost the birth rate. The idea being that if you have free preschools, you lower the financial burden of raising a child. Maybe more parents will be willing to have kids.
Yeah, and so the overall impact then on the macroeconomy, we get more and more of these measures in place. At some point, this really adds up.
Yes, and this is really a consumption stimulus in disguise, right? Because the government has announced that they want to expand consumption of goods, but also of services. And that led to speculation about whether or not the government is going to expand those subsidies beyond home appliances and electronics to services as well. And now we are seeing these subsidies coming through in the childcare sector, in preschools. We know that elder care is also another sector earmarked for expanded services as well. So it's going to add up to, boosting consumption. I remember when I spoke to a demographer many years ago, he told me that demographics has been one of the most underrated factors driving growth, because parents are just hardwired to spend on their kids. You think about, the amount of money you pay for your fertility services, the medical checks, and then your swimming lessons, your ballet classes. And he said that, the easiest money to earn is from a mother. So I guess this is all part of that. You boost the number of babies, you boost growth as well.
Min Min Lo, fantastic. Thank you so much. Great context there out of our China correspondent. In some other corporate news we're tracking this morning, Meituan is launching this program of subsidies to support more small restaurants. Okay, let's try that again. In a statement on WeChat, the company says it wants to help small outlets achieve stable growth and fight against over-competition. Now, Meituan and its delivery rivals, including, we talked about Meituan and JD.com here, recently promised to curb what Beijing called disorderly competition under pressure from government officials to curb this price war. Now, Bloomberg has learned that the Alibaba Group, to be more specific, is winding down its members-only stores. Its supermarket chain Hema has begun closing premium outlets that require an additional or annual subscription for access. The move marks a strategic retreat from a model that struggled to compete with Costco and Walmart's Sam's Club. Now, Bloomberg has learned that OpenAI is in early talks for a secondary share sale that could value the company at around $500 billion. Sources say investors, including Thrive Capital, are looking to buy shares from current and former employees. OpenAI's previous valuation stood at $300 billion in a $40 billion financing round, then led by SoftBank Group. We will leave you with a look at markets where most benchmarks are on the downside. The Nikkei, though, going into the last, 7 minutes of the morning session, is higher by about 0.6%. Welcome back. Here are some of the big stories we're tracking around the world. Israel is said to be weighing a full military takeover of Gaza, despite concern among military chiefs and the public that such a move jeopardizes the prospect of Hamas freeing its remaining hostages. An Israeli official also told us that the plan would face considerable international opposition. Now, Prime Minister Benjamin Netanyahu plans to convene his Security Council to finalize a strategy. President Trump says Scott Bessent does not, to be more specific there and clear, does not want to be nominated to succeed Jay Powell as the next Fed chair. Now, Trump told CNBC that Bessent says he wants to stay on as the Treasury chief. Trump also says a decision on a replacement Fed governor will be made within the next few days. Right, a quick glance at FX markets, where it's really about dollar supports, and does that hold? The data suggests that we might break some of the key levels there. We've been trading at about 1209, 1210 on the Bloomberg Dollar Index. It's quiet though across currency markets today. Right, welcome back. You're watching the China Show. Ooh, well, okay. Big step back and quite a quick one at that here. A fifth of 1% to the upside across the Asia Pacific. A lot of that is really down to some of the big moves we're seeing in Japan, 6/10 of 1%. The rest of the region, they're either flat to slightly lower. Topics index, 1.1% going into the lunch break. Right, goes into really what we're checking here today as far as Chinese markets go, and we're down about 0.25% on the Hang Seng Index, HS Tech as well. We've been keeping an eye on southbound flows following, I think, the biggest net purchase yesterday across a southbound stock connect going back to April, which follows the biggest net selling on aggregate, net going back to, I think, May. So that's certainly something, a wall of support that's really come across the border, and why these benchmarks remain still quite big. Shanghai Composite, it's worth noting, is extending, and I'll be extremely generous here because it's only about 2.5 points, extending a 3.5-year high close that we had on Tuesday. Okay, we've been talking about this. Min just took you through the report on the focus on free preschool education, and some of the baby-related, childcare-related names are on the way up. Number one. Number two is China equipment stocks, policy support. That's coming up on your screens as well very, very shortly. And some of the heavy equipment makers, of course, on the back. Yeah, there we go, of support of financial resources there. Weihai, Huadong, automation up. That should be limit up. There we go. Traded in Shenzhen. And we've been tracking the EV space. So, I mean, pick your buy the dip potential option here. So XPeng is down still. Li Auto is leading declines, has been leading declines, and BYD still can't catch a bid. We're now trading at about 110 right now from about north of, I think, 130, I think, was the peak back in early May. Now, all that being said, I think BYD reports in about 2.5 weeks or so. And speaking of earnings, the reason I bring that up is Cathay Pacific's actually out in a couple of hours. On that, we might get is the operative word, might get confirmation here of this Bloomberg scoop that Cathay is poised to actually order new aircraft from Boeing for the first time in 12 years. Now, sources say the purchase plan could be announced as soon as these earnings, which come out in a couple of hours, in what could be a major boost for Boeing's 777X program. Now, Cathay will also unveil its first half results, with analysts expecting improved earnings and robust passenger demand and lower jet fuel costs. And that could aid, if not justify even further, share price up by half over the last 12 months or so. But some analysts are actually warning that the rally may be running out of steam, citing valuation concerns. Let's bring in Charlotte Yang, our Asia equities reporter, who put out this nice piece for us, of course, on the stock going into these earnings. What set the stage for us here?
Yeah, so on the earnings front, we're likely to see continued solid momentum. But I think the real question here, let's ask our analysts, is how much upside there is. Up to now, the shares had a 50% rally over the past year, is now trading at a highest level in 6 years, and also already ahead of the consensus price target, and also valuation has become less attractive. But first, on the earnings front, we're likely to see a rise in the revenue as well as operating profit boosted by strong passenger demand, as well as lower jet fuel cost. However, net income could be weighed on by the continued losses we're seeing at Air China, where Cathay holds a 50% stake. And also what being focused will be on Cathay's, any guidance Cathay can give in terms of cargo, which investors had many concerns given that cargo is a very important unit to Cathay, but also that how it's so sensitive to the trade tensions and the e-commerce flows from between China and the U.S. So again, it's really about how much upside there is still for the stock. And analysts now, their buy rating has dropped to 1/3 versus the full quorum last year. So that is to show you some of the cautious sentiment there.
Okay, let's stay on earnings. Yum China reported, I think, before the U.S. markets opened yesterday. What can you tell us about that?
Yeah, so Yum China, we saw pretty heavy sell-off in the shares in Hong Kong, both in Hong Kong and overnight in the U.S., which has baffled many analysts because they feel like the second quarter results is quite strong. And also, it actually shows you that the company took a pretty balanced approach in terms of protecting their margins while, and also, to boost sales. But what investors didn't like is about its guidance for the second half, which some people feel is too conservative. So they are expecting the same store sales to stay steady for the second half, even with, given the deliveries, the delivery war that's ongoing, which help, boost some of the volume there. And also, the company is cutting their cash return to investors in 2027, another thing people didn't like. And I think short-term wise is this in continuing competition and also in the rational consumers that are thinking about how much they spend, and that's not boding well for the company. So even though the second quarter results is okay, concerns persist for the second half.
Charlotte, thank you so much. Charlotte Yang, Asia Equities reporter on, the two big corporate stories right now moving these markets, right? You have Cathay Pacific, and earnings are coming out soon, and of course Yum China, which, again, baffling some people on the street there given the decent earnings, but the, I guess, opposite reaction, expected reaction in the stock price. Right, some other corporate news that we're tracking today. NVIDIA and Apple partner Hon Hai saw, July sales slow by 7.25%, marking the weakest performance since January as tariff concerns hit electronics demand. Still, Hon Hai is expanding its U.S. server production, betting on big tech, spending even more on AI infrastructure and capacity. It may also have gained from strong iPhone demand as Apple reported its fastest quarterly revenue growth in more than 3 years. Now, Apollo Global Management posted a record profit from fees in the second quarter, fueled by a boost in lending activity and also managed assets. The firm collected, get this, $61 billion in the quarter, boosting its managed assets to get this, another whopping number, $840 billion. That's well ahead of expectations. Now, the rising inflows and fees contributed to a 17% jump in adjusted net income. Right, shares of German auto chip maker Infineon climbed in Frankfurt, that's past tense of course, as the company said it would take less than a tariff hit than expected, while also forecasting stronger margins. The CFO, Sven Schneider, told us that more of this strategy is actually key in the Chinese market.
The number one position we are enjoying in China is a very strong one, which we are also defending. How is that possible? First of all, you have to have the right products. Secondly, you have to continuously invest into innovation. And we have here some very good examples on very new technologies, but also on pretty mature technologies like low power, mid-high power MOSFETs, where the next generation brings our customers 20-30% efficiency gains. The product to system approach, where we are not simply selling pieces and components, but a full system to a customer. These are things which keep us at a distance to international and also Chinese competitors. But you are absolutely right. The speed with which innovation is happening in China on all ends is mind-blowing. We are responding to that very successfully. That's why we are designed in not only in international, but also in the top leading and emerging Chinese OEMs and tier ones. But we have to keep going. And I also have to confess, and that's no news, we have said it repeatedly, there are also certain product categories, we call it commodity products, low power products, where we are losing intentionally market share, given that the business is no longer profitable enough for us. That's also part of the journey, but enjoying the broadest product portfolio is a very, very big differentiator for us going forward.
And another part of the journey is not only innovation for you, it has also been inorganic growth, acquisitions. I'm thinking of Marvel Technologies over in the United States. When you think about the long-term strategy at Infineon and you think about other acquisitions in the future, what kind of category of activity is still missing in your portfolio? Where would that come from?
So first of all, I'm happy to share with you that the Marvell Automotive Ethernet acquisition, after a pretty short time, has received already all regulatory approvals. So we expect this transaction to close in the near future, which is good news. It strengthens our microcontroller business on the automotive side, but also beyond automotive, it opens new opportunities for Infineon in adjacent fields like humanoid robots. So that's very positive. M&A is always and has always been an important part of Infineon's growth journey. International Rectifier, Cypress, GaN Systems, Marvell, and we will keep looking into opportunities. They have to fit, of course, clear criteria, strategic fit, financial fit, very important cultural fit, because many transactions are healthy and good, but they do not materialize because culturally it doesn't work together. And of course, we are looking into areas, for example, to mention sensors or software, where it could be interesting to enlarge our portfolio even further.
There we go. Conversation there with Oliver Crook, our colleague. And by the way, you can catch that for our Bloomberg client subscribers, can catch that on the TV Go function. You can watch us live. You can scroll back if you missed that interview or others that you might have missed from our programming in the last, even take it back a week if somehow you get an itch for something that we did, a rerun of the China show this time last week. Not sure why you do that, but it's available in case that floats your boat. Check it out, TV Go. Plenty more ahead. This is Bloomberg. Good morning. Welcome back. You're watching the China Show. The Reserve Bank of India is going to be the next landmark or landmine, depending, of course, on which side of the FX equation you're sitting on, or bond yields have been effectively steady. This one's going to be a rather close one, given, well, for one, when you look at the split from economists, it's about a third actually think they might move today. The broader conversation has been really on lower rates, right? So about 100 basis points. You had 25 in Feb, 25, and then 50 in the last one as well. It's a complicated conversation because if it's only inflation or if it's only the slowdown to consider, it's more straightforward. But you have this uncertainty over the next 24 hours with what Donald Trump might actually impose on India, right? A higher tariff, substantially higher. We're already talking 25%. Okay, we're looking at, we're going to correct this for you because it doesn't add up to 100%. That's interesting math, though. That's actually 12 economists, and 12 economists think they're going to cut, 25 think they're going to hold. We'll correct it for you, and I promise you we'll show you that to you in a moment here. Well, in the meantime, let's bring in our team to talk us through this. Our South Asia economy editor, Ruchi Bhatia, joins us out of Delhi. And also joining us right now is our Bloomberg government reporter, Sudhi Ranjan Sen, to help us understand the many complexities going into this specific rate decision. Sudhi, let me bring you in and start with, it's rare, if not the first time we're looking at an RBI rate decision talking about Russia and energy links and Donald Trump. Set the stage for us. Why do those things matter at this point in time?
Well, it matters because, India needs energy, and it needs energy at a reasonable cost for its economy to grow. And with the war in Ukraine and Europe cutting down on supplies from Russia, substantially reducing its purchase from Russia, the oil that was available from the Gulf, is short. And therefore, and at the same point of time, Russia is selling oil cheap. It is selling. There is a price cap that has been put on Russian oil. It's selling at that. So, as a democracy which is growing, it's the point that India is trying to put forward is that its purchase of petroleum products is market driven, which means that whichever or wherever there is cheap energy, it will purchase. However, what we see of late is that President Trump has all of a sudden linked the issue of trade and the trade negotiations, the tariff, with India's relationship with Russia. Of course, the reason is that President Trump wants to end the entire Russian war in Ukraine, but has not been successful. So there is a lot of pressure now coming on India to end its relationship with Russia, with the intent of putting more pressure on Putin.
How would that look, though, Sudhi, domestically? In other words, do you think the bluff from the White House works?
Well, so far it hasn't worked. India has been very, very, resilient in that. In fact, it's been defined in a way saying that it's, to ask India to stop purchasing oil from Russia is not going to work. In a very uncharacteristic statement that we saw from New Delhi day before yesterday evening, it clearly said that the European Union and the United States both continue their trading relationship, continue to buy stuff from Russia, and the trade between India and Russia is much smaller, in fact, than what European Union buys. So clearly pointing fingers back at European Union, which is also has criticized India for buying oil from Russia, at the same point of time pointing fingers back at Trump.
Okay, now this goes into the RBI decision, Sudhi Ranjan Sen, and help us understand how this complicates what should be fairly straightforward, really, for the RBI today. Okay, I think we're going through some technical issues. Sudhi,
was
can
that
I just
question for me?
Yeah, go ahead. Oh yeah, so I was just wondering. So we just outlined the geopolitical conversation that somehow has permeated into the RBI conversation today. It should be more straightforward, but it's not, at least for this specific meeting. Help us understand the complexities here.
David, this is definitely going to be a very tough one coming in for the central bank, because if you see in the last few days alone, the expectations have shifted from a no cut to a scenario where many economists just in the last few days have shifted their calls to a 25 basis point cut with the hope that there is a need to cushion the Indian economy. Having said that, Governor Sanjay Malhotra has already said that if inflation falls further, and remember it is already below the RBI's 4% target level for 5 months in a row, or if growth falls further, because as against the 8% growth that we saw in the last few years, we're now at a 6.5%, and the tariff shock could further, shave off another 30 basis point of growth. So this time around, the central bank will have to make those considerations. The fact that it's not just the 25% tariff that Donald Trump has announced. He's also said that he will look to substantially increase the tariff. So there is a lot of uncertainty that's playing out, and that will definitely be front and center of what the rate setters are likely to consider today.
What does the inflation trend tell us about what should be the decision today or at the next meeting?
The inflation trends are looking very good. In fact, we have a good monsoon. The sowing pattern looks very good, and it does look like that inflation will continue to remain below the RBI's target level, not just for this year, but perhaps around the same level next year as well. So on the inflation front, there is a lot of comfort that the central bank is drawing. Where they're not drawing comfort is on the growth front, where there's a lot of uncertainty playing out. And remember, even the Indian domestic economy is not doing very well, because there is still a slowdown of sorts that we're seeing in the urban centers where wage growth is fairly stagnant, and that is a big worry for the government. For how long will the government keep spending by itself? That's really helped the government in the last few years in terms of pushing growth. But till how long will that lever really work? Because there is a slowdown in terms of exports. On the other hand, investments are not picking up, and there are there is this broader global uncertainty, a global slowdown that will feed into today's decision making as well.
Team, fantastic. Can hardly wait, really. Ruchi Bhatia there, of course, and Sudhi Ranjan Sen, both in Delhi for us, really on really a big one. today. In fact, just on the very note, we just showed you the pie chart with a corrected one, and apologies, of course, for the minor error earlier on. So it's split. Decently sized minority think, 30% actually think we might get a move today. So a couple of things in case you do need more context here. One is the podcast, of course, and the price. Really, if you think about it, the price of India's reliance on Russian oil could come in the form of a rate that should be lower, but it's not. Just tying those two things together. You can check it out on the terminal for our Bloomberg subscribers. And also, if you check out the TL Live Go function, which takes you through the action in and around and during that rate decision, which comes through in a couple of hours. Stay tuned for that. Plenty more ahead. This is Bloomberg. Welcome back. You're watching The China Show. Lots of corporate earnings to tell you about, corporate stories. We are in the thick of things, of course. BP shares, of course, in case you missed it, up in London, 3% as of the close on Tuesday here. Second quarter earnings easily beating expectations there. That's a day after the company announced an oil discovery off Brazil. That's the biggest find in a quarter century. But CEO Murray Auchincloss is actually pledging that the company can and will do better as it launches a review of its businesses and costs. Now, he also told us that he is upbeat about overall energy demand.
Demand remains pretty robust, if I'm honest, despite all the headlines. 1% growth in demand over the past 20 years or so. 2025 looked like 1% demand growth. 2026 looks like 1% demand growth to us from different sectors, from petchems in 26. But demand growth continues to be strong for the product.
Let's talk about Tesla. So the company posting another steep sales decline, this time in Europe, as it loses ground to China's BYD. We'll talk about BYD in a moment here. But yeah, July sales in Germany and in the UK fell by more than half from a year ago. That's based on EV registrations. By contrast, you have BYD's similar metric of registrations. They're more than quadrupled in each country. Now, the ongoing slump adds to concerns that Elon Musk's political activities are hurting the brand. Okay, speaking of BYD, it's really a stock that we've been tracking. You know, a lot of fund managers hold the stock, and certainly the declines we've seen of late is one of concern. And we've talked about this earlier on in the first hour of the China Show. Is this now good value for the stock, given, number one, how quickly the share price has receded? That's market cap of about now $45 billion. That's a rough estimate from my count. That's been erased from the peak back in May. Technicals, it's below the 200-day moving average for the first time in about 12 months. And ditto when it comes to the 14-day RSI, which is now, by the way, below 30 for the first time also in 12 months' time. As far as the stock price target goes, we had a conversation earlier with Macquarie, and they're basically saying they've revised it down, but still do expect the company shares to still move forward ahead. Okay, apart from that, Shanghai Composite is one specific benchmark in the greater Chinese equity market that's actually done better than others. In fact, at these levels right now, the chart takes you back all the way to 2015, even further back. If you take it back to 2013, that blows off because of that aberration that we had in May of 2015 going into August of that year. But yes, suffice to say, we're very close right now to taking out the highs that we had during the pandemic. And it's really one that's had somewhat of decent momentum. Could be down, if not down specifically to index constituency. Anyway, keep your eye on Shanghai Comp. Right, other things. Yum China out with earnings yesterday. We're down about 5%. Big drop about 6-7% in the ADR session overnight. And something that is puzzling because it was a decent set of earnings, but again, it underscores competition within the consumption space here. But yeah, don't make no doubt. 2Q earnings actually coming in ahead of forecast. Now, we talked about these baby-related stocks, and again, I think for the third time this hour, in case you missed that, yeah, policy support leading to a rally as far as these markets go. Before I go, keep an eye on HIBOR. Wasn't one yesterday. There should be one today. Comes out in the next hour. We will see you all tomorrow. Thank you for joining us here on The China Show.